When people talk about artificial intelligence in finance, there's usually this built-in assumption that we're just dealing with like a giant, incomprehensible calculator.
Yeah, the classic black box.
Right. The visual is always someone just dumping a trillion data points into this box, turning a crank, and waiting for it to spit out a stock pick. And if you actually ask the machine why it picked that particular stock, it essentially just shrugs in binary.
Which, honestly, is the big machine learning problem across almost every industry right now. I mean,
Right.
you get incredibly high predictive power, sure.
But no idea how it got there.
Exactly. Absolutely zero interpretability. We get the what without ever actually understanding the why.
Which is fine if you're, just getting a movie recommendation. But it's terrifying if you're managing billions of dollars.
Oh, absolutely terrifying.
But then you look at actual human academic research, and it's the complete opposite, right? A human researcher is meticulous. They build a foundation based on economic logic. They test very specific hypotheses.
And they have to explain every single step to peer reviewers.
Yes. So the idea of an AI actually doing that kind of research, like acting as a genuine methodical scientist instead of a glorified slot machine, has always sounded a bit like science fiction.
It definitely has. But that line between a black box calculation and autonomous scientific discovery, it is getting very, very blurry.
Which is why we're here. We are doing a deep dive today to see exactly how blurry it is. Welcome to the deep dive, by the way. I'm your host, and I'm joined by our resident expert.
Great to be here.
So we're unpacking a genuinely fascinating paper from April 2026 titled, Can AI Do Financial Research? LLM-Guided Hypothesis Discovery and Asset Pricing. It's a highly rigorous academic study by researchers at Google, Boston College, Columbia, and CKGSB.
Yeah, heavy hitters. And the core mission of this paper is wild.
Yeah.
We're looking at whether an AI, specifically Claude Opus 4.6 in this case, can actually act as an autonomous financial researcher.
Not just crunching numbers, right?
Right, no. We're talking about it actually proposing, testing, and then refining economic hypotheses to find anomalies in the stock market.
And doing it all with completely transparent, interpretable logic.
Yes. That's the critical shift here from previous AI models in finance. We can actually, read its mind.
So for you listening, whether you're managing your own portfolio or you're just curious about the future of AI and white-collar jobs, or maybe you're trying to figure out how to collaborate with AI in your own daily workflow, this deep dive provides a literal blueprint for how humans and AI can divide intellectual labor. Okay, let's unpack this.
Let's do it.
Before we even get to what the AI discovered, we have to talk about the setup. Because unbounded AI doesn't really discover things, does it?
No, unbounded AI hallucinates.
Exactly. If you ask an unrestricted language model to just go find a stock market anomaly, it might just string together a bunch of random financial buzzwords.
Yeah, stuff that looks great on paper, but fails completely when you apply it to the real world. The researchers obviously knew that. So they built this highly structured laboratory for the AI.
A sandbox, basically.
A very strict sandbox. What's fascinating here is they gave the AI a very specific constrained grammar, like a symbolic expression language. They restricted it to just 66 specific Compustat accounting variables.
Things like a company's total assets, R&D expenses, long-term debt, that kind of stuff.
Exactly.
And just to pause there for a second, Compustat is basically just the standard, heavily vetted database of corporate financial statements, correct?
Yes, it's pretty much the gold standard for historical financial data. So the AI has these 66 variables, and then they gave it 24 mathematical operators.
Like its tool belt.
Right. These are things like calculating growth rates, finding moving averages, making industry adjustments, and they gave it the ability to nest these formulas up to 6 levels deep.
Wow.
But the key is, the AI couldn't just write free-form Python code or scrape Reddit for sentiment data. It had to build formulas out of those exact accounting blocks.
I love this setup. It's like, we didn't just turn the AI loose in a giant supermarket with an unlimited budget and say, make dinner.
Right.
We gave it a specific pantry containing exactly 66 ingredients and 24 cooking techniques, and we said, bake me a cake that predicts stock returns.
That's a perfect analogy. And they gave it thematic constraints for the recipe, too. The AI was asked to combine 8 different economic themes, like combining profitability with investment or valuation with quality.
And every single hypothesis it generated was strictly tested on real historical market data, right?
Yep.
Like spanning from 1963 all the way up to 2024.
Yep, real data.
I did notice in the methodology that they deliberately excluded microcap stocks. They focused on what they called value-weighted portfolios. Can you translate that for us? Like, why does leaving out the tiny companies matter so much?
It matters immensely for real-world application. A microcap stock is a tiny, often highly volatile company. You might hear them called penny stocks.
Sure.
If your AI finds a statistical pattern that only works on penny stocks, no institutional investor cares. You can't actually trade those stocks at scale without moving the market price yourself.
Oh, because just trying to buy them ruins the advantage.
Exactly. So by excluding them and weighting the results by the value of the companies, meaning larger companies have a larger impact on the test, they ensure the results are actually realistic and investable.
Got it. So the humans built this rigorous, completely unforgiving gauntlet of a laboratory. The AI cannot cheat. It can't massage the data to make itself look good.
Nope. It proposes a hypothesis using its pantry of ingredients. The fixed pipeline evaluates it against 60 years of stock data and then returns a grade.
Which is why this division of labor is so smart. The humans design the lab and the definitions of success, and the AI just executes the discovery loop inside it.
And because of that, the hypotheses remain interpretable as actual economic statements. We don't get that black box noise. We get a mathematical formula we can actually read.
Okay, so that brings us to the actual experiment. We have the sandbox built. What happens when we press play?
Well, they ran the AI through 7 evolutionary generations, labeled Generation 0 to Generation 6.
And in Generation 0, it hasn't gotten any feedback yet, right? It's just flying on its pre-trained financial knowledge.
Exactly. And its pre-trained intuition was surprisingly sharp. In Gen 0, it had a 44% hit rate.
Hold on, let's clarify that. The paper says a successful hit means a proposal passed the standard statistical significance test of a t-statistic greater than 1.96.
Right.
For those of us who haven't sat in a college stats class in a decade, what does that actually mean in plain English?
It basically means we are 95% sure this result isn't just random luck.
Okay.
In finance, if a signal has a t-stat over 1.96, the correlation between the AI's formula and the actual stock returns is strong enough that it's highly unlikely to be a coincidence.
So 44% of the time, on its very first try, with zero feedback, it's generating signals that are 95% likely to be real. I mean, that seems really high.
It is. Just for context, the researchers ran a programmatic single-theme benchmark to compare it against.
It's like a brute force algorithm.
Yeah, exactly. Just a computer smashing variables together without any language model logic.
Yeah.
That benchmark only hit a 34% success rate.
Wow. So the AI's initial intuition was already beating standard programmatic search.
But the real magic happens when the reflection loop kicks in. They fed the AI the results of its own tests from Generation 0.
So it sees what worked and what didn't.
It sees everything. Successes, failures, wrong sign guesses where the market did the exact opposite of what it predicted, and outright mathematical errors.
And it learns from that.
Oh, massively.
Yep.
By Generation 5, after iterating on that feedback, its hit rate skyrocketed to 78%.
78%, that's insane.
Yeah. Out of 280 total proposals across the whole experiment, 159 were statistically significant. And the quality of the signals improved, too. The absolute t-statistics climbed from an average best of 4.47 in Gen 0 to 6.26 in Gen 3, and just stayed elevated.
Okay, I have to be the skeptic here for a second. Is it actually learning, or is it just doing what computers do best? Meaning, is it just rapidly throwing millions of math equations at a wall until something sticks? Like, I could write a script that generates 10,000 random formulas a second. How do we know it's not just brute forcing the sandbox and getting lucky?
It's a fair question, and the researchers anticipated that exact critique. The AI isn't just rapidly guessing. They gave Claude Opus 4.6 a 10,000 token budget for internal chain-of-thought reasoning before it was allowed to output its next proposal.
So it has to think out loud before it answers.
Yes, we can literally read its encrypted thinking traces. It's actively reflecting on why previous formulas failed. It makes targeted structural changes, not random variants.
Give me an example of that. What does that actually look like?
Well, the AI might look at a previous failure. Notice that a specific accounting signal is too volatile from quarter to quarter, and explicitly write in its trace that it needs to shift to a moving average operator to smooth out the noisy data.
Oh, wow.
Yeah. It's diagnosing the illness, not just trying random pills.
That is a bold claim. So to prove that it's using economic logic rather than brute force, we should look directly at an instance where it completely bombed a test and had to course correct.
The paper provides some incredible case studies of exactly that.
Yeah, let's look at the one in the profitability multiplied by intangibles theme.
Ah, the R&D intensity reversal.
Yeah.
This is a perfect example. So in Generation Zero, the AI hypothesized that R&D productivity would predict high returns.
And its logic there was that companies generating more gross profit per dollar of R&D spent are more productive innovators, therefore their stock should go up.
Right.
Honestly, that makes perfect intuitive sense to me. If a company's getting more bang for their research buck, I'd want to own that stock.
It makes complete intuitive sense. But the historical market data proved it entirely wrong. The tests came back with a significant negative result. The market actually favored the opposite behavior.
Here's where it gets really interesting. Reading the AI's internal trace, it didn't just throw out the R&D variables and try something totally unrelated.
No, it diagnosed the core issue.
It realized that the stock market doesn't actually reward the short-term efficiency of the R&D. It rewards the raw intensity of the R&D relative to the company's size.
Exactly. It reasoned that highly efficient R&D might actually mean a company is underinvesting in its future, whereas massive R&D spending relative to market equity signals aggressive growth.
So it completely restructured the mathematical signal to focus on R&D to market equity instead.
It went from a failed hypothesis to a highly successful one by interpreting the failure exactly as an economist would. It flipped its own paradigm based on empirical pushback.
And we see an even more profound version of this in their second case study, right? The one in the investment multiplied by financing theme.
The leveraged stock breakthrough, yes. Initially, the AI kept trying to combine two flows.
Meaning things that are actively changing.
Right. It was multiplying asset growth, a flow of new assets coming in by debt issuance, which is a flow of new debt.
And its reasoning was that firms rapidly expanding and taking on new debt to fund that expansion are overextending themselves, so their stocks should perform poorly.
But the pipeline told the AI those results were mediocre. Then, in Generation 2, it has this conceptual breakthrough. You can read it in the trace.
What did it say?
It explicitly writes that highly leveraged firms face higher costs of financial distress. So it decides to abandon the financing flow, the new debt issuance, and swap it for the financing stock.
The existing level of long-term debt already sitting on the balance sheet. I love this because it perfectly illustrates the difference between a flow and a stock. It's like the difference between measuring how fast water is flowing into a bucket versus realizing the bucket is already full and about to burst.
That is a great way to look at it.
If the bucket is totally empty, a little bit of water flowing in from new debt doesn't really matter. But if you already have a massive stock of debt on your balance sheet, any rapid new asset growth is incredibly risky.
Exactly. The AI figured out that the danger isn't the new debt, it's the pre-existing fragility. And that signal, which it named leveraged PP growth, became one of the strongest predictors in the entire study.
Which is exactly what human scientific discovery looks like. An aha moment where you realize a foundational assumption was just backwards.
And the data backs up this capacity for genuine discovery. The researchers classified the novelty of the AI's proposals against known academic literature.
How did it score?
Its success rate on novel combinations, taking known variables and combining them in completely undocumented new ways, was 62%.
That is staggering.
Compare that to when it accidentally recreated a direct rediscovery of an old, already published market anomaly. Its success rate on those old ideas was only 18%.
So its true strength isn't just regurgitating textbooks it read during training. It's a master of combinatorial creativity. It takes known human building blocks and finds the hidden joints between them.
That's a great way to phrase it.
But I'm looking at the numbers here, and the AI generated 159 statistically significant signals. On the surface, that sounds like an infinite money glitch.
Yeah, it does.
So why aren't we just plugging these 159 formulas into a brokerage account and retiring to a private island? There has to be a catch. The stock market is not a charity.
There is absolutely a catch. Modern finance is famously ruthless to new anomalies. The academic landscape is just littered with signals that look incredible on a first pass, but vanish the moment you look closer.
Enter the gauntlet.
The gauntlet. They put the AI's surviving signals through an absolute meat grinder of a testing pipeline. They didn't just stop at that initial 95% confidence screen.
Right. First, they ran a multivariate horse race to eliminate redundant ideas. Because the AI was frequently generating like 5 slightly different mathematical versions of the exact same underlying concept.
Yeah, they had to isolate the signals that actually had independent predictive content. That horse race alone dropped the list from 159 down to just 38 independent survivors.
And then came the true gauntlet, They adjusted for multiple testing. Explain multiple testing to me, because it sounds like a statistical buzzkill.
The easiest way to think about multiple testing is flipping a coin.
Okay.
If I flip a normal coin 1,000 times, just by sheer probability, I'm bound to get heads 10 times in a row at some point. If I only show you that one sequence of 10 heads, you might think I have psychic powers.
Right, but you just did a ton of tests.
Exactly. In finance, if you test thousands of random variables, some will look highly significant just by random chance. Adjusting for multiple testing raises the mathematical bar to prove you aren't just the guy who flipped the coin 1,000 times.
Makes perfect sense. And after that, they tested the surviving signals against modern multi-model factor alphas. Specifically, the Fama French 5-factor and 6-factor models. What are those doing to the AI's signals?
A factor model accounts for the known rules of gravity in the stock market.
Like what?
Well, we already know that small companies tend to grow faster than large ones. We know that cheap value stocks behave differently than expensive growth stocks. The Fama French models measure those known forces.
Oh, I see. So if your AI's brilliant new signal is basically just a complex way of buying small companies, it hasn't really discovered anything new.
Right, it just rediscovered gravity. The signal has to beat those models to prove it has unique value.
And they went even further. They tested those survivors against 209 published anomalies from the famous Chen Zimmerman library, just to ensure the AI didn't reinvent the wheel.
And finally, they checked post-2010 subsample data to make sure the signals hadn't decayed over time as modern algorithms made markets more efficient.
Okay, so what was the final tally after this gauntlet?
Massive attrition. Most of the AI's brilliant, mathematically sound discoveries were heavily absorbed by known factor structures. They were just capturing the same profitability or investment premia that human researchers had already found decades ago.
So how many made it?
After all those brutal, modern statistical filters, only about 6 to 9 signals actually survived.
Wow. I have to be honest, that sounds terrible. We started with 280 proposals, we hyped up this whole evolution loop, and we ended up with maybe 9 truly novel, unexplainable signals. That's a 97% failure rate.
It sounds bad when you put it like that.
Right. If an employee gave me 280 ideas and only 9 were usable, I'd probably fire them. Is this whole experiment actually a failure?
This raises an important question. But no, it is absolutely not a failure. In fact, it highlights a profound truth about the empirical landscape of finance.
Which is?
The space of accounting-based signals using Compustat data is already heavily mined. Thousands of PhDs and quantitative hedge funds have spent the last 50 years looking at this exact same data, searching for an edge. Finding even one completely unmined, robust alpha signal in this data is often a career-making achievement for a human researcher.
Okay, framing it like that changes the perspective entirely.
The fact that the AI independently reconstructed decades of human financial research in just 7 generations is astonishing. It proves it's an incredibly efficient navigator of human knowledge, even if the landscape itself is already crowded.
And unlike human researchers who might be tempted to, tweak their data to get published, the AI was locked in a cage.
Exactly. It survived a standard of testing that most human papers from the 1990s would fail today.
It didn't fail to find the gold. It just turns out humans had already mined most of the easily accessible veins.
Right.
But it did find a few nuggets that survived everything. So let's talk about the crown jewel of this study, the UltimateAlphaComposite.
Yes. By generation 6, the AI created a signal it literally named UltimateAlphaComposite. Again, reading the trace is what makes this so remarkable.
Because in its internal reasoning, it explicitly noted that it had discovered 2 entirely distinct information channels during its earlier generations, right?
Yep. One was based on structural balance sheet fragility, that leveraged stock idea we talked about with a bucket of water.
And the other was based on active, concurrent market timing decisions. Basically looking at firms that were raising debt and spending capital at the exact same time.
And the AI deliberately combined them. It wrote in its trace that because these were economically distinct mechanisms, they should be largely uncorrelated.
It reasoned that combining them would create a diversified alpha source superior to either one alone. The paper calls this a synthesis of orthogonal alpha channels. I know orthogonal technically means at right angles, but in this context, what does it mean?
It means completely independent strategies that do not overlap. Imagine you own an umbrella store and a sunglasses store.
Okay.
They're orthogonal businesses. If it rains, the umbrellas make money. If it's sunny, the sunglasses make money. The AI found two completely independent financial strategies and wove them together to create something incredibly robust.
And it worked. The composite signal passed every single test in the gauntlet. It beat the Fama French 5 and 6 models, it beat the Chen-Zimmerman test against 209 anomalies, and it held up across all the time period subsamples.
A purely original synthesis of independent ideas.
Which brings us to you listening to this. I marvel at how this applies directly to whatever you do for a living. You don't need to be a quantitative hedge fund manager to use this blueprint.
Not at all.
If you're doing research in biology, or you're analyzing marketing campaigns, or trying to optimize supply chains, you can set up a laboratory just like this one tomorrow morning.
Exactly. You give the AI your structured data, you set up strict, unbreakable evaluation rules, and you let it run that reflection loop.
And it can find those orthogonal, uncorrelated solutions to your problems that you might never have seen simply because you're too close to the material.
The paradigm of human-AI collaboration has shifted. It's no longer just a tool, it's a junior research partner. If you design the sandbox correctly, the AI can build the castles.
So we've explored how a carefully constrained AI can autonomously navigate complex databases, learn from its own failures, deduce actual economic logic rather than just brute-forcing math, and discover robust signals that survive the absolute most rigorous academic testing available.
It's a massive leap forward.
So what does this all mean? I want to leave you with a final thought to mull over. In this study, the AI achieved all of this using highly structured, very clean accounting data. We are talking about rows and columns of numbers and rigid mathematical operators.
The cleanest data possible.
Yeah, right. But the real world is mostly made of unstructured data. If an AI can perfectly recombine strict financial variables to predict stock returns by learning from its own logic loops, what happens when we unleash this exact same autonomous research loop on messy, unstructured data?
Oh, wow.
Think about consumer psychology, employee emails, or global social media trends. It's like we finally built a metal detector that can learn geology, and we're about to point it at human nature. Are we about to see AI discover laws of human behavior that we have been completely blind to? Something to think about. Thank you for joining us on this deep dive. Keep asking those big questions, keep building your own sandboxes, and we'll see you next time.